I'm going to talk about the economic outlook for cattle and hogs with a couple of rabbit chasing things here that are important for this business. Why is this up? It is working. Okay, we're going to talk about demand first. Macro conditions, still pretty good. GDP growing about 2%. That's nothing to write home about. Real personal disposable income has slowed down on its growth from a little over 2% last year to about 1.5%. This is a pretty important factor. Just relating, the Pork Board just completed a pork checkoff evaluation that they do every 5 years, and in that process, Dr. Harry Kaiser at Cornell estimated demand and supply equations for pork, and that include the consideration of competing meats. And one of the things that came out of that was an income elasticity, which is how much does demand grow if income grows. That was about 3 times as large as what I've seen before. And so that calls it into a little bit of question that it was that big a number, but it underscores the importance of incomes to pork demand. And we've seen some of that the last few years. We saw some real troubles during the recession. We saw some real robust demand coming out of the recession. And so this is an important figure. Employment growth is still strong. We've had 3 months this year that we've had over 200,000 added to the payrolls out there, and we added over 2 million last year for the 6th year in a row coming out of the recession. So this is still a positive. Consumer attitudes are the best they've been since the early 2000s. This chart is of the Consumer Confidence Index. That's the red line put out by the Conference Board each month. The other one is the University of Michigan's Consumer Sentiment Index. You can see both of them have gone up dramatically since last fall. It's interesting that they both took off in the month after the election. We'll see if that optimism lasts for very long, but it certainly is there now. I think consumers have very strong attitudes about the future. Grocery store sales growing again, not as fast as they did in 2015, but back up in the 2 to 3% range. Restaurant sales have been trending slower as we've gone through last year and this year. Part of that is, if you look at price indices on these, restaurant prices have not come down nearly as much as grocery prices have. And so I think that's part of the reason their sales are going down. Neither one of these are in areas that we would really be concerned about, but still lower than they've been recently. Now, we use a measure real per capita expenditures as a measure of demand. This is for beef, pork, and chicken. We don't include turkey here because the USDA retail price for turkey is not very good. It's a whole bird price. So it leaves out all those value-added turkey products, and we think it's misleading. And so we just use the 3 species, down 5% from a year ago. We knew that this was probably going to be a little bit soft as we went through the year, and we're comparing to still very large numbers in 2014, 15, and 16. If we look at the individual species, you can see upper left is pork. We dug a pretty big hole for ourselves in January and February on real per capita expenditures. March was much better. April is above the 5-year trend. This is the first month this year that all 3 of the major species have been above the 5-year trend for real per capita expenditures. Beef is still down about 5% last month. Chicken down 4% year to date. So kind of equal performance across species here. Retail prices increased pretty sharply coming out of last fall. They've now started down a bit for pork. We're going to see I think we're going to see beef prices break pretty substantially as we go through the summer. We think that's a big risk for the beef industry, and some risk for pork prices too, is that these beef prices have been so high lately, and we've got a lot more cattle that have been placed the last 5 weeks 5 months that are going to be coming on to push those prices down. So we think retail prices will trend downward as quantities grow here as we go through this year. A few words about beef. There are 2 things that you need to grow the beef industry. One of them is profits, and the other one is grass. This is that drought map that Eric showed you is the red areas here, superimposed over the major and minor beef cattle areas of the United States. And you can see that very few areas of beef cattle numbers are being impacted by this drought. Really, the southeast and some little areas of Texas would be the major ones. I know I live in Oklahoma now. That little area of drought in Oklahoma is probably gone now. We had a lot of rain in southern Oklahoma last week and the week before. Cow-calf returns have gone down sharply Of course, they were record high in 2013 and 14 when we had shrunk the cow herd after the droughts of 2011 and 12. We started to rebuild that cow herd, and so guess what? There's more calves available. Calf prices have come down, and those profits have gone away. We're still building the cow herd because once you start that process, it takes a while for it to kind of come to fruition. But we think that the cow herd building will probably stop next year sometime as these profits are just not going to support it. Herd expansion, you can see total cattle inventories. The last light blue line there is 2017. So that's our forecast for 17 to go up to about 93 million head, beyond 95 million head in 2018, and larger in 19 and 20 where the peak will be. The beef industry is an aircraft carrier. You do not turn it very quickly. And so this minimum will take us for a while here, back up to the highest cattle numbers we've seen since before 2000. So a pretty big growth rate. A few things about cattle on feed, and this is kind of the things that cause us to be concerned about the summer. If you look at placements in the lower left, you can see that late last year we were short on placements, and that started changing in November and December when placements started moving toward the top of that blue area, which is the highest placements in the last 5 years. This year, they've been outside the blue area all 4 months that we have data for. So 6 months hence, there are a lot of cattle coming. If you look in the bottom right-hand corner, that's the number of cattle that have been on feed 120 days or more. Long-fed cattle that are going to start coming to town pretty quickly. You can see we were short that number in November, December, and into the first part of this year. Look what happened last month. We're moving toward that 5-year peak, and I think we're going to surpass that when we get the May data in. When those cattle start coming to market, we're going to have a lot more beef available, and we think these cattle prices are going to probably break from the mid-130s back down into the teens. The cutout value probably from $240 or so back down toward $200, and that will put some pressure on pork prices. It's one of the reasons that we don't think hog prices are probably going to get to where the futures are right now when we get to the summer. That's our forecast for the moment. We'll talk more about it. Average returns, feedlots are actually making some money for a change. They've had huge losses over the last couple of years because they just simply paid too much for cattle going into the yards. This time they're setting us up with break-even somewhere in the 110 to 114. So even if we sell these cattle prices off, they're probably going to be close to being in the black. Our forecast for commercial slaughter there, you see in the gray in the middle, that's total cattle slaughter. We were 7.3% larger in the first quarter. We're going to be about 5% larger here in the second quarter. The third quarter only 3.6, but part of that's because we have one less slaughter day in that quarter. And then, of course, 2% in the fourth quarter. Average for the year, 4.4. Steer and heifer slaughter in the right-hand column, up a little more than that. Cow slaughter is going to be a little bit tighter. Commercial cattle slaughter, you can see those big numbers coming in the red line out in June, July, August, and September. That's going to put some pressure. And notice where the forecast, the projection for 2018, the gold line is. Significantly higher on cattle numbers. We've got beef production up another 4% in 2018 coming on. Now, the thing that's keeping beef production down is these weights. And because the supply of market-ready cattle has been pretty tight, feedlots have dipped further into those supplies and pulled lighter cattle. That's probably going to start changing once we get into June and July. The weights are going to catch up with next year as the supply of market-fed cattle gets larger. Beef production, when you add the two together, cattle numbers, cattle weights, weights are kind of pulling down the production numbers a little. Notice we were over 4% for slaughter a while ago. On our numbers, we're at 4.2% for production. Here's the scary one, if you aren't scared already. And this is commercial beef production projected out past 2020. And those are huge records, big increases going forward. The last observation, light blue there, is 16. So you can see when we get out there to 2020, we're going to produce 30 billion pounds of beef once we get out there. So large pounds of beef coming at us. They're going to be formidable competitors once again in the marketplace. One thing that's made things better for them this year, just like it has for us, beef exports are up 25% this year from a year ago. Beef imports are down slightly, and the biggest reason for that is in the bottom right-hand corner. Australia is back into a herd building mode. They were in a liquidation mode for a couple of years, and we bought a lot of boneless beef from them When they were liquidating those cows, they're now not liquidating cows, so our imports from Australia are getting smaller. Per capita beef supply, if we divide that by the population, it's going to grow for the next 3 or 4 years. The last blue line, light blue line there is 2017. But notice it's not going to get back to where it was before the last liquidation. And if I took this thing back all the way to the 70s, it would look the same. Beef production, when they get into a liquidation, it goes down. When it comes back, it doesn't go back where it was. It goes down again, it doesn't go back where it was. And the reason for that, in my opinion, is that the other species can respond so much better. When they short the market with beef, it gets filled up with chicken and pork, and there's just not as much room there for beef coming out of it at a price competitive standpoint. So back up to about 62 pounds per person. We think that's as far as this is going to go. The cutout, of course, we had a big rally in May up to about 240. We can see this is the impact that we have on this of these larger supplies coming in the summertime, with that cutout back down almost to $1.90 there in October. Cattle prices rallied to over 145. We've got them back down below 120 once we get to July. We think that that's going to be a big factor. So if you take beef back down to less than $200, that's going to make it considerably more competitive with pork in the marketplace. And that's one of the things that we think is a risk on pork prices going forward. Okay, one little aside here, and this I've been posing this question in presentations this year. How many hogs did you negotiate a price for this week? Okay, and there's somebody going like this, and there's a whole lot of people going like this. When you do that, you let somebody else negotiate the price, right? And you think that it's this guy doing your negotiation, when in fact it could be these guys. All right? You're trusting someone else to do that job for you when you formulate hogs. Now, that's not necessarily bad. I think the guys that have been negotiating have been more like Warren Buffett than Garth and Wayne and Garth here. But still, the number, this is the dark blue line down here, has gotten down to an alarmingly low level. There's some statistical measures. There's a thing called chebyshevs theorem. I always say that. It makes me sound a little bit smart. Yeah, I don't use the word theorem very often. That is a mathematical equation that says, based on the variability of the price and the number of transactions, it can come back and say, what is a number of transactions that will give you a certain level of confidence that the actual price is close enough to the true price that should happen by a certain margin. 90% confidence interval within 50 cents of the price. That number has gotten low enough that you can't reach those two markers. The markers. You're not as confident that it's actually representing the true price, and that just happened in the last couple of years on this negotiated market. Growth of Packer-owned pigs is the brown one. Of course, a lot more swine and pork formula, and a whole bunch more pigs on other other purchase arrangements recently. USDA is throwing anything that has a non-carcass premium in it. Crate-free, never-fed antibiotics, whatever it might be, all goes into those other purchase arrangements. So they've come out of the formula. You can see they're almost a mirror image of each other and gone into that. But still, right at 2% of the pigs being negotiated. A higher chance, what happens is when you get that number low, you have a higher chance of a mismatch between the supply and demand of those kind of marginal pigs that are in the negotiated market. If we're off by 10 loads at 2%, that's a whole lot more impact than if we were off by 10 loads and we were negotiating 10% of the total on the supply and demand. And so what we see is when we have a few extra pigs, we see the negotiated price drop further below the other prices. That's especially true in the fall of 16 when we had packing capacity issues. Now, it's hard to talk somebody into doing more of something that costs them money. All right? I realize that. So that's a challenge. We're going into a different time, though. With new packing plants open, it's more likely that you're going to be in a situation where packers might be chasing a few pigs. So I think it's going to pay more to be in the negotiated market with some of your hogs. Nobody's arguing that you ought to negotiate all of them, but we probably need to negotiate more than 2.5% if we want a viable price coming out of that market. What are the solutions? Well, by far the best is for producers to do more. And notice I say producers. This is squarely on producers' shoulders. Packers have always been in a position where they told us for many years that they would be very willing to buy more hogs on the spot market. They like a lot of hogs on contract, don't get me wrong, because they know they're coming, but they're willing to buy more on the spot market, but producers have not been willing to sell them. So that's the best one. But we've spent a decade of trying to convince people that they ought to do more of this, and it clearly hasn't worked. Second one was be moved to the cutout value, and that's happening. The cutout value is much better now than it was before mandatory price reporting for pork products came along, because it represents a far broader sampling of the pork out there every day. That's an alternative. It's something that a lot of people are doing. I think it is a viable thing for you to look at. The third one, as an economist, I like this one. It's a market solution. To me, this says that we have a non-market solution out there that's because this data is free and because no one gets paid to produce it. Guess what? We don't produce enough of it, and it gets overused. And so you could have a market solution where the users of the data pay the generators of the data that would solve that problem. That's really complex. I can tell you how to do it, but it is complex. The fourth one is the M word, mandatory. That's getting a little more play. This has been talked about for a long time, of a mandatory requirement for spot purchases. Now, I will say this. It's always been aimed at the packer. I think it has to be a requirement for both buyers and sellers to sell a certain amount in negotiated markets if you're going to do it, because what that would mean is if it's just the buyers, there will be some sellers be forced to do all of theirs in the negotiated market, while others are allowed to keep their contracts. And finally, there's an issue of education. A group of producers were together earlier this year, and we got to talking, and one of the topics that came up was that, we might not have very many people out here that even know how to go about this anymore. And I think that's true. I don't think there's a lot of folks out there that know what to do when they're negotiating hogs, how to approach it. And so the Pork Board is going to have a price negotiating training meeting sometime in early September. The location has not been determined. It's going to focus on how to negotiate. And it's not going to have a whole lot of economists talking to you about theory, so I probably won't be there. I won't be on the program. I think I'll be at the meeting. But it's going to be led by producers who have actually negotiated, and they're going to tell you what information sources they lean on, how they go about making their calls, how they go about negotiating with packers when they're on the phone. Very hands-on. So if you're interested in that, watch pork.org, www.pork.org. Watch all of the pork industry publications, National Hog Farmer, Pork Letter, and others. There's going to be a lot of things about this, publicity out there telling you where and when this meeting will be held. I think it'd be worth your time. All right, let's talk about Hog Outlook. The great thing that's driven the hog market this spring is exports. We've had a remarkably strong year of exports, up 14.6% on a carcass weight basis from a year ago. April was a little bit slower, 7.7%. We've been up double digits the first 3 months of the year. But this is the real driver, in my opinion, of what's happening in our hog markets this year. Far better than anybody expected. Our forecast for the year was 4.5%. USDA's was a little over 6, I think. So all of us are kind of catching up here. We think that these numbers, year-over-year numbers, will get smaller as we go through the year, but still we're probably going to have to increase our annual forecast. Where has it happened? Mexico's been a big driver. Mexico is still up 12%. They were up over 20% those first 3 months. China, Hong Kong is way down from the surge a year ago. But notice that March was significantly higher than February, and April was higher yet on the brown line there. So still some good performance there. Canada's been okay, up 4%. Japan up 0.6%. Korea, big growth, 25%. The other one to note there is the green line, which is other. That's all the markets except for the ones listed here. Now, the 5 that are really driving that are Australia, Honduras, Dominican Republic, Guatemala, and Philippines. Of those 5, 4 of them, the first 4, were parties to the most recent round of free trade negotiations that we completed and free trade agreements that we executed about 5 years ago. Those aren't fully implemented yet, okay? But they underscore the importance of these free trade agreements. Those markets were negligible at the time we got free trade agreements, and they continue to grow. They've been real success stories. That tranche of other markets is now the 3rd largest among all the individuals that we do business with. So very important, and it underscores trade negotiations. We'll come back to that in a minute. Cost of production, as Eric told you, a good outlook for corn. We're kind of on the cusp of, if it rains, we're going to have plenty of corn and beans. If it doesn't rain, we'll be a little bit short. I will point out, and Eric did too, having a carryout of 2.2 billion of bushels of corn and 450 million bushels of soybeans, and having that huge South American soybean crop gives us a lot of cushion for any kind of shortage we have. I don't think we're going to have very high costs, even if we have a poor crop. But right now, the best producers are about $61, $62 on a carcass weight basis. The average would be about 65 or 6. Those are the lowest numbers we've seen for sure since 2010 and maybe since 2007 on cost of production. And so if you compare those numbers to the futures market today, there's not very many numbers on there that would be a loss in any month as we look forward. And so it looks like a pretty good time period for us, or at least you can take advantage of that. The Hogs and Pigs report in March told us there were a lot of pigs coming, and guess what? There have been a lot of pigs, and there's going to be a lot more. The numbers were right on line with expectations, large market inventories, a few screwy numbers out here in the farrowing intentions, and we think those will get washed out when we get the June report. But we think that the June report is going to show us more of the same, and this is a real credit, in our opinion, to USDA. They spent about 3 years really chasing this market and not doing a very good job, missing the pig crop consistently to the small side. December kind of represented a retooling, in my opinion. Their numbers were a lot bigger than people expected because we'd been grown to expect small numbers from USDA. And they've been about right. The March numbers were right where we expected, but larger than a year ago, significantly so. And they've been pretty close to right. And so I've been pleased with that. I hope they can continue to get that. They had the pig crop up 4%, the Feb pig crop, and so those pigs are just now starting to be slaughtered. We'll see how well that fits, but if the recent past is any indicator, we think it's going to be pretty good. Litter size, I still don't like their revision policy where they change anything. The ex ante looks bad for the pig crop. They just go change the farrowings. I think they should be changing litter size because farrowing is more predictable. And if they had changed litter size over time instead of farrowings, then their averages would be the red line, which would really fit with pre-PEDV litter sizes far better than the post-PEDV ones that they published. Here's our forecast for quarterly slaughter. Second quarter up 4.6%. Third, 1.5 on one fewer slaughter day, an important factor there. And then 4% in the fourth quarter. And that's 4% from last fall's records. Okay? So we're talking some heady numbers here. 122 million for the year, up about 3.3%. You can see our first quarter forecast there from Iowa State, LMIC, and EMI. We got pretty close on that one. I hope we can do as well on the rest of them. Market hog imports are about as we expected this year, down some from a year ago, but notice that our forecast, the blue smooth line, gets way bigger as we go through the year. We may have the increase in there too early because that is really tied to the opening of the Coldwater, Michigan plant. We're going to see more hogs coming from Ontario when that plant opens. One of the producer owners, investors in that plant owns operations in Ontario. Plus, there's a lot of Ontario hogs that have been moving to Quebec over the last 3 or 4 years that I think, especially with the exchange rate where it is, would prefer to come to Michigan. So we're going to see an increase in market hog imports in the second half of this year, probably in the fourth quarter. Weaned pig imports, very wiener and feeder pigs, very volatile. Still, the average is pretty close to where we thought we would be, and again, we think there's going to be some growth in that number relative to a year ago as well. Hog slaughter, we've been pretty close on our weekly totals. Notice that at the third quarter, we get a little closer to last year, but the fourth quarter, significantly larger slaughter numbers. And while last year we were at slaughter capacity or beyond it for 11 or 12 weeks there in the fourth quarter, we're going to be pretty close to capacity this fall. A lot of it depends on how quickly the plants get ramped up. But I think we're going to be pretty close to capacity for 3 or 4 weeks even this fall. With all these new plants coming on, we're still increasing output. And 2018 says we're going to increase output even more. We're going to need the space that's provided by the Prestige plant, even though I don't think it will be up in time to help us much in the fall of 18. This is the growth, the new and coming packing plants. Of course, Pleasant Hope, Missouri opened last fall. Windham, Minnesota opened in April. The two big plants, Sioux City and Coldwater. Did anybody catch the Triumph press conference today? Or it's Seaboard's this afternoon? We've heard that they're probably not going to make their July 31st announcement on opening. I'm sure that will be a topic of the press conference. So the folks at Clemens say they're still going to open Coldwater on September 5th. Those will get ramped up this fall. They won't be up to their 12 and 10,000 head per day numbers by the end of the year. A very aggressive double shifting plan was announced earlier by Triumph Seaboard. It'd be interesting to see if that is mentioned today too, May of 18. And then, of course, the Prestige plant won't be really a factor in the market until the fall of 19. But that's almost 10% more slaughter capacity than we had this last fall in just 3 years. 3 years. That's a big growth rate. And if we were to kill that many more hogs, and if weights start to grow again like they have in the past, you could be 13, 14% more pork on the market in 2019 than what you were just last year. And that was a record. All right? So just do the math. The population grows at 0.7%. All right? So we're going to outrun that pretty quickly. We have to either get people to eat more here or export more or both in order to keep this thing where we need it to be. We're very concerned about what just the general price situation will be in 2019 with that much product coming along. Weights have really helped us since last fall. Last fall, the weights remained steady all during the fourth quarter. They continue to do that this year. We think they'll start gaining year over year once we get into the second half of the year. A lot of reasons. It's not just, well, the price is bad. Well, the price is good, and we're still not increasing weights. And a part of it is there's far fewer hogs being fed ractopamine than there were just a couple years ago. There's probably far fewer hogs being fed the level of antibiotics they were, either just because we're not using it for growth promotion or because of the veterinary feed directive. We know we have some space limitations in some farms. When some farms start raising 30 and 32 and 33 pigs per sow, they may not quite have enough finishing spaces for those. And so if they don't, they're going to have to sell them a little earlier. These will be rectified over time, at least the space one will, and we will go back to heavier hogs because they pay better for the producer, and they certainly pay better for the packer to push more pounds through that plant. So we think they're going to go back to growing. FI pork production up 3.5% so far in the last 4 weeks. We've got it up 3.8% for the year. Again, a lot of that increase, the difference in the red and the blue lines, happens out in the fourth quarter. Sow slaughter spent the first quarter higher than we had expected and has dropped kind of right back down to those numbers recently. Still up 3.2%. You can see some growth there as we go through this year. We think that the sow slaughter thing has been hard to track the last 2 or 3 years because PEDV got our parity structure so out of whack on most farms. And so we've been kind of catching up with that. I think we're back to reasonably normal. There was an article, I think, in National Hog Farmer last week about higher levels of death loss. And so that's going to be interesting to see if we can support these sow slaughter levels if that's happening. The weights of sows have come down sharply relative to a year ago here recently. And so that has limited somewhat. The first part of the year we had a lot more sow product on the market. Now we have about the same amount. Yes, sir. This is live weight. No, it's carcass weight. Pardon me. Carcass weight on sows. That's a good question. I may have the wrong, I think I've got the wrong title on that. Where's Ty? I saw him. He must have left. Eric's looking for Ty. The guy that knows all this, and I think it's live weight now that you asked the question. I believe it is. Okay? FI sow product production has dropped relative to the first quarter in the last 6 or 8 weeks. And so we've seen this real rise in sow values that have commensurate with that. Total production, record large in 2015, record large in 2016, will be record large again this year. We'll exceed 100 billion pounds of the 4 major species next year. Per capita availability, we've got it back up to 216, or about 217 this year. Our projection is 219 next year. At this rate, we're going to match the record of 2006 of 220 pounds in 2019. I think we're going to get that done. I'm really surprised by that. I thought when we dropped back down with all the changes we were having with animal welfare concerns and all the young people that we hear are vegetarians, at least until they eat bacon, you know, we thought that that might have an impact, but we're pushing it right back up to those levels again. There's the per species. One thing about hogs, if you know, if anybody asks me how much pork are people going to eat, I'll take 48 to 52 and give you the field, because that's been the number, except for the high corn price years, for 30 years. We don't eat it doesn't vary very much. So if you're going to grow production, you're going to either have to get people to eat more or export it. That's my point. And it's hard to get people to eat more than about 52 pounds of pork per year. We went into May with large total meat, beef, pork, and turkey cold storages and chicken. All of the increase relative to a year ago is turkey. The three other species were lower on that May 31 figure, and you can see frozen pork inventories down 6%. Bellies were still well below a year ago, even though we have been gaining on them. Ribs right at the same as the last year. Ham inventories very close to their 5-year average, but 12% lower. I put these four up here. You add those three cuts right there, and other pork, and you've got about 70% of the cold storage inventory. If you take butts and loins and all those, they're really a pretty minor number. So these are the ones we watch pretty closely. Price forecasts. Second quarter, we were at 70. The average price, national net price across all methods, was just over $70 in the first quarter. We've revised all of these higher in the last couple of weeks. 69 to 72 in the second quarter. You can see them there. 72 to 75 in the third quarter. 61 to 64 in the fourth. Average for the year, 68 to 70. Higher price than last year on more hogs and more pork. That's good demand at the farm level. That's great demand. Notice that the lean hog index, or CME futures over on the right-hand side, are higher than our cash forecast. We still think the futures market is giving you good pricing opportunities for these third quarter hogs, July and August especially. We think the fourth quarter, pretty good, 65. It's actually a little above the top of our range. So we would think you'd be taking some advantage of those prices. And you can see here where they've been in the past. The blue is the June 1 prices, record high or contract life highs for those there in May, June, July, and August. The numbers all the way out through 18 are very close to as high as they've been. We would be looking at some of those summer 2018 contracts and probably taking some coverage and start your marketing, start your pricing plan at the levels that those are right now. With 4% more hogs next year, and you won't have a lot more packer competition next year than you have relative to what you're going to see this fall. Those still look like pretty good prices out next year. From a profit standpoint, with our model, with cost in the low 60s, and this would be for the best producers, and the average net price across all methods in the U.S., profits of almost $20 per head this year. We don't have the whole year next year, but it's not going to be too far off of that. You could lock in right now on the futures. Someone asked in a press conference this morning, said, how long are we going to grow this breeding herd? And I said, until we start losing money. And as a matter of fact, probably until we lose money for 2 years. That isn't in our forecast at all. So we could see continued growth of the breeding herd for at least the next 12 to 18 months. Cutout values up in the 93 or 4 or 5 range this summer. Stronger than a year ago, significantly so, especially in the second half of the year. That's what it looks like right now. Some softness in the second half of 2018. National weighted net price of hogs up around $80 this summer. There'll be some $80 hogs in there if you're going to have monthly averages that close to 80. If we go to weaned pigs, the normal kind of seasonal pattern with low prices this summer, rising in the fall. That's a pretty good one. Our model on that has an R-squared or predictive power of about 97% because everybody uses the same factors to price weaned pigs. National sow prices, of course, we've seen this good rally here since February. We think those are going to hold for most of the summer in that $55 to $60 range. Okay, risks. The biggest risk we always face in this business is stopping exports. Okay? And that would happen by foreign animal disease. Programmed disease would be the number one. The other one is President Trump disease. That one is an uncertain certainty. We don't think that there's anything that the administration is going to do that's probably going to have much impact this year, and maybe even next year. But the whole deal on the trade negotiations, long term, is awfully important. I think one thing that's good about this deal is these people have negotiated and have been wheeler dealers all their life, and that's different than the politicians we've had in the past involved in this. So I think that's good. It's also a little bit disconcerting at times because they have been negotiators and wheeler dealers all their lives. So we'll see what happens. Renegotiated the NAFTA, we were one of the big winners there, so it's easy to see where we might not be the winner the next time around. I don't think renegotiating the NAFTA is a bad idea, depending on where you end up at the end of the negotiations. And so we'll have to see what happens there, but it's going to happen, no question. Bilateral agreements with all these countries that were in the Trans-Pacific Partnership, that could be a good thing too, depending on how the negotiations go. So we'll have to see how that turns out. Diseases, these are supply-impacting diseases like PEDV and PRRS. They weren't too bad this last year. We know that on PRRS we're one mutation away from having a wreck on our hands again. PEDV, we're getting better, I think, at handling that, and so we'll have to see what happens in the coming, but that is certainly a risk to this forecast. Feed costs, there's still a lot of risk here based on the weather. When do you price 17 and 18? If it stays dry, if it turns dry and stays that way, we're at the lows. If it starts raining, you'll be able to price your feed much lower come harvest time. So that's a risk. Demand, still a risk. Will we see any growth this year? Wages and income preferences are important. On the export side, what happens with the U.S. dollar? This weakening dollar is a real positive for exports. If we can continue that and keep the dollar below 100 on the dollar index for an extended period of time, I think that's a positive. Mexico, I put it up there because they're in the midst of a big expansion in south of the border, adding maybe 15-20% to their sow herd over the next 3 to 4 years. That's going to change the dynamic, because they can keep that low-value product in Mexico and compete with us in Japan with their free trade agreement on their high-value product. Impact of the competition for hogs this fall, we've got about $3 in our forecast because of that. We know some people that's got more than that. I think that these plants are pretty well lined up with hog supplies they're going to need this year. I don't know that they're going to chase them very hard, but we're still moving supplies from one packer to another at a pretty regular basis. Finally, and I alluded to it earlier, what about pork prices in 2019 if we get all these plants full? Questions? Yes, sir. Feeder calf? Well, we think all the calf price, I had a chart up there and I skipped right through it. All the beef prices are trending downward and going to get cheaper as we go, because we've still got a bunch of heifers that we've added to this market that hadn't had their first calf yet. Okay? So supplies are going up on that.